One of the attractions of so-called alternative investments is that you don't see day-to-day swings. We're joined now by Mark Steffen, Global Alternative Investment Strategist at Wells Fargo Investment Institute. Thanks very much indeed for joining us.
Yeah, good afternoon. Thanks for having me on.
It's a broad topic. Give us a quick definition of alternative investments. I know there's an awful lot of areas here.
Yeah, absolutely. It does become sort of an all-encompassing term, but the way we define it here at the Wells Fargo Investment Institute includes hedge fund strategies as well as private capital strategies, including private equity, private debt, as well as private real estate.
Right. Start off with hedge funds. For the typical hedge fund, how much money do you need to invest? Can you give us a ballpark, or is it possible to do that?
Yeah, I mean, it really depends on each individual situation. There is a broad array of different types of structures that are available for different qualified investors. But one of the big trends we're seeing as of late is really called the democratization of alternative strategies. So, meaning we're seeing a tremendous growth in structures, and they go by many names, but they're often called evergreen funds that are more accessible to a wider audience and really possess attributes that many investors prefer. So in addition to lower investor qualifications, they offer greater liquidity, typically quarterly liquidity windows with limitations at the fund level. They offer greater transparency, so they're subject to more stringent reporting requirements, as well as just improved tax reporting. And lastly, they're fully invested at day one versus the typical private equity or private capital fund. It tends to be slowly invested over the course of the first 1 to 3 years. So these evergreens have a lot of attributes that investors are seeking and are really more accessible to a wider array of audience.
I think you referred to liquidity windows there. Is that the opportunity people get to actually take their money out of the fund, and it's arranged in advance?
Yeah, that's correct. So the liquidity windows, typically investors are allowed to redeem their shares or their units on a quarterly basis. However, these really should be viewed as more long-term investment options, and that liquidity may not be there during market dislocation. So it is important to position this with clients as a long-term investment and thought of as a long-term holding. That being said, during normal market environments, they do have a feature whereby investors are able to get their money back if they so choose.
I'm thinking about private equity. I mean, you could just buy KKR stock, but what would the advantage of going into a non-traded private equity investment be?
Yeah, absolutely. So, I mean, you could buy a KKR stock, but it's not quite the same as getting exposure to, direct exposure into private companies. So, by going with a non-traded vehicle, you're able to invest in a large swath of the market that many people may not even know about. So, we've seen tremendous growth in alternative investments in general. And I think, most investors are focused only on the public markets. Many investors don't even realize the extent of the private company universe that lies outside the realm of the public markets. And, if you look at firms in the U.S. With 100 million in revenues or greater, private firms actually account for about 89% of that total number. So by avoiding private companies, you're really missing out on a vast landscape of available investment options. And another trend we've seen is that the number of public companies has really been in serial decline over the last few decades, peaking at over 8,000 publicly listed firms in 1996. That number declined to around 4,800 here in recent years, so almost a 40% drop in the number of publicly listed firms. And many businesses today are choosing to stay private longer, which means much of the value that's accrued during the early faster growth phases of the firm's life cycle is really accruing to private market investors. And if you look at, even the mega cap tech firms that are driving markets today, many of those transition to the public space as large cap companies and completely skipped over the small and mid cap phase during their public life cycle. So there's a lot of reasons why companies decide to remain private, including the ability to avoid costly regulatory requirements, and the ability to focus on long-term strategic plans as to public market entities that pay greater attention to some of the shorter-term financial results. So there's advantages and disadvantages to each side, but investors that can allocate across both public and private markets really are in a position to capitalize on the broadest array of opportunities to reach their financial goals.
It's interesting that, Jamie Dimon, as you probably saw, the boss of JP Morgan not so long ago decried that, saying we're losing an important source of information about the economy with the decline in public companies. We'd better jump. Thanks very much indeed for joining us.
Yeah, thank you.
Mark Steffen, Global Alternative Investment.